Hi, Jason Greenlees. Happy New Year. Want to do a short video on what transpired in 2025 and share my thoughts on what we're potentially in store for in 2026 and how we're positioning portfolios accordingly. So let's start with last year. Last year, despite being a pretty wild roller coaster ride, ended up being really good for investors in the end. Looking at some of the benchmarks, the TSX, the Canadian benchmark for Canadian stocks, was up almost 30%, one of the best returns in history. The S&P 500 did okay, didn't do as well as other markets, which I'll share in a second, but it was up 15%. Unfortunately for Canadian investors, the Canadian dollar went up 5% relative to the US dollar. So in Canadian dollar terms, S&P 500 was up about 10%. Chinese market was up over 25%. European stocks were up over 25%. So really good year in the end for investors. Unfortunately, I think most people are going to remember 2025, not for the strong returns. They're going to remember April 2nd, aka Liberation Day, where Trump announced his sweeping plans to tariff the entire planet. So if we kind of look at 2025, in April, when we got the Liberation Day, the markets tanked. The S&P 500 dropped close to 20% over a 3-week period. NASDAQ, made up of technology, U.S. technology stock, was down close to 30% over that 3-week period. And so I've said in other videos, we got a lot of phone calls from clients about that, asking the old age question, should we sell? My answer then was the same it is now, no. And of course, that worked out. The stock market by the summertime had erased all those declines, went on to set new highs, and by October, by the end of the year, all-time highs again is where we ended up on the market. So pretty remarkable year, but if you look at the beginning of the year and the end, of course there was a lot of stuff that happened in between. So if we look at what happened in 25, there were some things that we did that really worked, and we did some things that didn't work as well. One thing in particular, and I'm going to start with that. So for our exposure to U.S. stocks, I chose to pick the S&P 500 equal weight, which if I put a microscope under it, you own all 500 companies that make up the S&P 500, and each one of them is 0.2% weighting of that portfolio. Versus the cap weighted index, which is made up, as a stock does well, it becomes a higher and higher percentage of the portfolio. So Apple's over 7%, Nvidia's close to 10%, I think, of the index. In fact, 7 stocks, the Mag 7 as they're affectionately known, make up more than 35% of the cap-weighted index. So when you buy that index, you're really overweighting yourself in these names. And I just think that at some point there's going to be a reversion to the mean, meaning that those prices will come down and go back to their long-standing average. And anytime, we've never had a concentration the way we've had now. We've had some that have been close, Nifty 50s comes to mind, and it always has ended badly. At some point, those stocks go down, the market broadens out, and other stocks catch up. So for the last couple of years, I've been wrong. We've owned the equal weight. It was only up 5% in Canadian dollar terms last year versus 10 for the cap weighted. So that hurt our performance. But my thinking is I want to be defensive right now. So I know at some point that's going to help protect our clients. So that was a bit of a drag on performance this year. Not major, but a little bit. What we got right was our quarterly rebalancing strategy, which captured the ups and downs of the market brilliantly. So in January, this time last year, the stock market had done really well towards the end of 2024. So all of our client portfolios this time last year had too much in stocks based on whatever their target mix was, whether it be 60-40, 70-30, 50-50 stock bond mix. So we would have sold some stocks in January, took some profit, and added money to bonds. Fast forward to April, Trump announces Liberation Day, stock markets tank. Now we sold some bonds, and we took advantage of the fact that the market was down, bought stocks at a lower price. Fast forward to July, third time we did our rebalancing. Now the stock market had erased all those declines. We took advantage of that, took some profit out of stocks, added money back to bonds. And then in October, our fourth and final rebalance of the year, stock market sitting at an all-time high, again, took more money out of stocks, added money to bonds. So really captured the ups and downs of the market last year. The other thing that worked is we And it's been a bumpy ride, full disclosure, but our exposure to Chinese stocks did really, really well last year, up over 25%, as did our exposure to European stocks. And we added a silver and gold ETF midway through the year last year, which did really well and continues to do really well so far in 2026. All in all, it was a great year. 2024, our clients had probably the best year in my 31 years of doing this. Last year was second best. So we've had two great back-to-back years in terms of performance, overall performance. And I've just sent out in the mail and to those who get it on email what your specific portfolio did, so you'll have that shortly if you're a client. But that's 2025. I think if I'm reading the room right, based on the calls that I've had, the conversations that I've had so far this year, most people are concerned and worried. And they're worried about what's going on in the world politically. And I'm not going to get into all of that. I mean, you watch the headlines, you watch what's going on in Davos right now. I'll leave it at that. They're worried and concerned about the way the world is going. The second piece is AI. Everyone talks about the impact. I mean, I'm using AI daily now, as I'm sure you probably are as well. Everyone's talking about what that might do to the job market and the economy. So there's that concern. And then the thinking goes something like this. Hey, we've had two great back-to-back years in the market. There's a lot of uncertainty in the world. Why don't we just sell everything, sit in cash, wait for the impending crash to happen, and then we'll go back in? And that sounds like a really thought out, logical strategy. Unfortunately, I've never seen it work, because you sell, then you got to know when to get back in, and no bell goes off saying, hey, market's safe, go back and get invested. By the time you feel safe and ready to get invested again, chances are, historically, the market's higher than where you sold. So even though you might get the first half right, you get it wrong. And I've shared that many times in these videos, stuff that happened with our clients during COVID. So no, that's not the answer. Staying invested is the answer. And then, of course, rebalancing the portfolio. So we do take a little bit of money. We just rebalanced again last week for clients. Again, market's even higher. So we've taken some more money out of stocks, added money to bonds, but not in any meaningful way, just enough to maintain the proper asset mix for clients. So the big part here is, if fear is starting to creep in, it's not a failure. It's just human nature. And our job, my team's job, is to slow that process down so that you don't make a decision or you make changes to your portfolio that are going to be to your detriment long term. That's really the strength of what we do. And the other thing that I would say is, so my theme going into 26 really hasn't changed, but it's worth repeating. Stay diversified. That is your best line of defense. If you happen to have all your money and you're not a client of mine and you've been fortunate enough to be in all U.S. technology stocks in the last 10 or 15 years, congratulations, you've done well. At some point, there's going to be a reckoning there. I don't know when. You should have some of your money in those types of stocks, but to have all your money in that one area, I think, is a recipe for disaster. And so we don't do that for clients. We have some exposure, but not a lot. We've also reduced exposure to U.S. stocks. I mentioned that in my last video. When I first started in this business three decades ago, the U.S. stock market comprised less than 30% of the world's equity market. Today, it's 60%. That just goes to show how much better the U.S. market's done relative to the rest of the world. That won't last forever. I mean, the world looks very differently today than it did 10 years ago. And 10 years from now, it's going to look very different than where it is now. And we're starting to maybe see some major forces in the world that are happening. Do not abandon your exposure to U.S. stocks, but I wouldn't have all your money in U.S. stocks either. So be diversified. Have some bonds. If you need liquidity and you're spending money, a lot of our clients have retired, don't have all your money in stocks. Have enough liquidity for the next 5 years that have nothing to do with the stock market. We are going to get a 20, 30, 40, 50% sell-off in stocks. I don't know when, this year, next year, the year after. It's going to happen. That's part of the process. And so you want to make sure that you're not going to have to sell stocks at an inopportune time to generate the liquidity that you need. If you're a client of ours, rest assured, we've already done that calculus on your behalf. And then just be disciplined. And if you're not, then that's what you've hired us for. And if you're not a client of ours, first of all, I'm going to ask you, when was the last time your advisor put out a video like this? I'm here for you. If you're watching this, I'd love an opportunity to do business with you and show you how we can help look after you. Put that aside. Back to clients. We're doing all this stuff on your behalf. If you're still worried or concerned and you want to have a conversation with me, get in touch with me through my staff or directly through me. Send me an email. I'm happy to have a conversation. We can revisit your asset mix to make sure that it continues to make sense. But really, like I said, take a deep breath. The things that are happening in the world, invariably these things come, they go, the markets ebb, they flow, and the only way that you get the long-term superior returns that owning good quality businesses have delivered is to ride through the short-term but sometimes painful declines. I wish there was a better way. There just isn't. Anyway, those are my thoughts as we head into 2026. I appreciate your continued trust, your confidence, and your viewership, and I'm here if you need to chat. Otherwise, wishing you all the best in 2026.